This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Brent crude blows past the $90 a barrel mark amid escalating tensions in the Middle East. The US shifting its stance on support for Israel to make it contingent on better efforts to protect civilians. Meanwhile, a direct conflict brews between Israel and Iran. Stocks under pressure ahead of the US jobs report, and with Minneapolis Fed President Neil Kashkari floating the possibility of no rate cuts this year if inflation moves sideways. The yen stronger on haven demand. And we'll take a deep dive into the sizzling stock markets of the United Arab Emirates, set to become home to companies valued at $1 trillion. It's just gone 8 a.m. across the UAE. I'm Bonnie Quinn in Dubai, and let's have a look at how we're shaping up for the Friday session. So if you didn't know any better, you would know that we are looking at an up session on Friday session, but the last 2 hours of the US session yesterday saw a whopping falling out of bed, if you like, of stocks. We had huge volume between 2 p.m. and 4 p.m. the close yesterday, and this was all after Neil Kashkari spoke and basically put it out there that, you know, it's possible there might not be any interest rate cuts this year. Now, he's not a voting member this year, and there were plenty of other Fed speakers that didn't sound so hawkish, but Neil Kashkari's seems to be the comments that held the day. We also saw that bid in Treasuries, and that sent the two-year yield to 464.32. Not quite as risk-off in Treasuries as we saw in stocks. Gold, though, near still that record, and Brent crude above $91 a barrel. This as Middle East tensions continue to simmer and, in fact, maybe perhaps even worsen at this point. We'll be checking in on all of those stories in just a few moments, so stay with us. But a lot going on in Asia as well, even as Hong Kong reopens. We want to get to Hong Kong now, and Yvonne Mann is there for us. Yvonne.
Hey there, Vonnie. Yeah, you mentioned about that oil price, and that certainly is benefiting one sector in particular when it comes to stocks amidst this risk-off day that you're saying. And it's really the oil stocks that you're seeing across the region. So S-Oil and Seoul were up some 4.5% this morning. Impex in Tokyo as well as Santos in Australia are both higher. China Oil Fuel Services, that's an interesting story here. They did file a notice saying that one of the customers in the Middle East had to suspend the operation of 4 drilling rigs. That's why we're seeing the stock plummet some 18% right now. So that's what's going on in the energy space. You look at what, broadly speaking, what we're seeing across Asia. You mentioned about that comment from Neil Kashkari. That certainly has sent some shockwaves across risk assets here. You're feeling that certainly in stocks, as you mentioned. It was weird to see that movement in treasuries actually bid up, which is counterintuitive in some ways, if higher for longer is really here to say. But you're really feeling that when it comes to the Nikkei 225, just what you're talking about, that strength coming through in the Japanese yen this morning. 225 is up, down about 2%. 8 shares also coming back from that holiday, and we are catching down, it seems, right now. But it's been a pretty volatile session here in Hong Kong, digesting all that Fed speak, as you say, and dollar yen. So there is that safe haven bid, as you mentioned. There's also some speculation out there that the BOJ Governor Kazuo Ueda gave this interview to Asahi in local news, saying, you know, really kind of adding to the case the possibility of maybe an additional hike from the BOJ this year. So that certainly is helping the yen. It's also helping when it comes to what we're seeing across yields in the short end of the JGB curve. The 2-year certainly seeing a bit of movement there this morning. And we're focusing on Samsung earnings as well. The stock is down, but this was a pretty blowout number. We're talking about 6.6 trillion won in terms of operating profit. That's a 10-fold surge from a year ago in these prelim numbers. So certainly there is a sign that perhaps a big turnaround happening when it comes to memory demand as well as prices, Vonnie.
Yeah, interesting to see the equity price moves. Yvonne, thank you so much. That is Yvonne Mann there in Hong Kong. President Biden has told Israeli Prime Minister Benjamin Netanyahu that U.S. support for the war in Gaza depends on new steps to protect civilians. The shift in position comes as Biden faces increased pressure to take a hard line against Israel as deaths mount. Bloomberg's Stuart Livingston-Wallace joins us now. This is quite a hard pivot on the part of President Biden. It may not seem it on the surface, but this is the first time that an actual crack has shown that produced an effect. That, of course, and the deaths of the World Central Kitchen workers.
But it's still fundamentally a vocal thing. And what you're going to need to see for a real change, a real pivot here, is for the arms shipments to stop. There's been something like 200 shipments from the US to Israel since October, thereabouts. When those dry up, that's when we know things have really changed.
What makes you think they will dry up?
I don't. I mean, I think the calculation that Biden is making is, on the one hand, he's, you know, obviously he's facing an election year. He's got some real problems in some places like Michigan, obviously because of what's going on in Gaza. On the other hand, he knows that there is a very strong support as well for this war within his electorate. So he's trying to balance those two things up and I guess trying to figure out how to navigate it. I'll be honest, I think he wishes it would all go away.
Yeah, I mean, it did produce results, at least. We saw almost immediate results. I do want to play you some sound, though. Nir Barkat spoke to us yesterday, and he had this to say about Qatar as an intermediary.
Qatar is giving safe haven to Hamas leaders, funding trillions of dollars, buying their ideology in the United States, buying their way in all over the world. They're a wolf in sheep's clothes, and we have to realize that them, together with Iran, are a big threat.
Why would he attack Qatar when Qatar has been trying to play the intermediary?
Extremely good question. And the timing is particularly bizarre. I mean, it does ignore the fact that, particularly with regard to the Hamas office in Doha, as far as the Qataris are concerned, they were asked to set that up by Washington because Washington needed some sort of intermediary, or at least that's the position they take. Also, they have been somewhat successful in getting hostages out. You know, you can't just give all the credit to Qatar, obviously. You know, there are other actors involved in this as well. I think it must reflect a degree of frustration. On the one hand, the War Cabinet now has tens, maybe hundreds of thousands of people out on the street protesting the seeming lack of progress on the hostages. So it's easy to blame the negotiator. But the reality is that is still the big political issue in Israel. He needs to sort that out.
And Stuart, I want to ask you about Israel scrambling the navigational tools in Tel Aviv yesterday in order to try and deter any kind of attack from Iran. Yeah. Will Iran attack Israel directly, or will Iran attack something to do with the United States?
So number one, I'm definitely not inside the heads of Tehran. Yeah. Very hard to predict. My assumption, just based on everything we've seen over the last couple of decades, that it'll go through the proxies. But I don't know that for sure. I mean, I would say that if you have a direct missile attack from Iranian territory into Israel, that would be absolutely unprecedented. Yeah. And then what worries me the most is how does Israel feel it needs to respond to that? And then it just, you know, it gets really out of control after that. I mean, it is already kind of out of control, but it's on a whole other scale.
The calculation on that one would take some time. Stuart, thank you so much. That is Bloomberg's Stuart Livingston-Wallace there in Dubai. Now to the outlook for Fed policy in Minneapolis. Fed President Neil Kashkari saying interest rate cuts may not even happen this year if progress on inflation stalls. Have a listen.
Wouldn't say they're off the table, but they're also not a likely scenario given what we know right now. If we continue to see strong job growth, if we continue to see strong consumer spending and strong GDP growth, then that raises a question in my mind, well, why would we cut rates?
Let's bring in Ryan Lamond now, CEO and co-founder at NeoVision Wealth Management, joining me here on set in Dubai. Ryan, Neil Kashkari is not a voting member this year, and yet his comments seem to have had huge sway. The market just completely fell out of bed afterwards.
Absolutely, because markets today, they're pretty much out of breath or momentum. It was driven by momentum until now, and now they're looking for direction. Unfortunately, the Fed members, Mr. Kashkari and others, are giving much more information than they should. They said we're data dependent. Let them be data dependent. Let's stop speculating. They should stop speculating. We will cut, we will not cut, 3, 4. This is harming markets. This is harming the U.S. economy. So
there's too much Fed speak. We'll have more later on. We're going to hear from 3 more Fed speakers today. But I'm just curious, if markets are so eager to believe that there may not be cuts this year, then why aren't they pricing that in? Why do they need Neil Kashkari to say, and by the way, if inflation keeps holding up, you know, we're not going to cut?
Oh, markets are still factoring in that there will be cuts this year. They're factoring on a soft landing where we're going to get at least 3 cuts in the second half of the year. This is the tune at the moment. But again, markets today, they're out of momentum, and they are looking for that momentum.
We have jobs data coming out of the United States later on, and the consensus number is 214,000. The whisper number, though, is more like 233,000. What kind of a number does this market want? A good number or, you know, a bad number?
Wow. That's a very wide question. So basically what's happening today is 2 opposing forces. The first one is fiscal spending. Fiscal spending is astronomical, and this is boosting jobs. So we're seeing lots of private companies letting go of employees, but they're being offset by government employees. So this is why jobs have been actually very good. So the markets would like to see jobs bad, because this is what will basically lead to a cut, and this is what markets are looking for, rate cuts. So as long as fiscal spending is happening and jobs are being boosted by these government jobs that are offsetting private job cuts, I think the economy will remain strong. But there are so many government employees you can hire to offset the private sector layoffs.
Speaking of cuts, it's a problem for other central banks that the Fed hasn't cut yet, and the outlook is a little bit murky right now. We're awaiting the RBI decision. Do they stay on hold?
I think they will stay on hold, and I think they should stay on hold as an economist, because basically inflation is still around 5%, above 5%. India's economy's GDP is 70% consumption. Inflation hurts consumption, so they need to control that inflation. However, general elections is coming up, so a rate cut would be welcomed by stock markets. So this is where it's a bit tricky. But I think 90% they will hold, they will not cut for now.
You're invested in India. You're also now selectively going into China. It's a theme this week, all of a sudden, that maybe the pivot is actually happening and that China is becoming attractive again. Where are you investing?
So we are going in multiple sectors, very well diversified, being stock pickers, because basically the Chinese government did not do a full support as they do usually. They've been very selective in the way they're supporting the economy. Industrial production is going up again. Demand is going up again. So we do believe China has bottomed out, and there are some amazing bargains to pick up. If you look at the world map with overvaluation in the US, Europe is starting to be a bit overvalued with the stocks index at 22 PE. Japan as well, things are changing. So China today is the best entry point for us.
Where are those pockets of opportunity, though? I presume you're not talking about real estate or anything associated.
Absolutely not. So one example is electric vehicles. So today China is coming in quite hot with electric vehicles. They are basically becoming price setters with regards to EVs. So that's a sector we really believe in China. Now, that's a risk to Europe. So we do believe that Europe will introduce some tariffs or some to hinder the potential imports of Chinese EVs, but it's a sector that we do bet in China.
And indeed, we saw orders for BID blow away estimates in the first 24 hours, so I can see your argument there. You're also invested in India, and there was little maybe talk percolating through the markets this week that perhaps India's gains are done, particularly with the election coming up, and maybe the gains are priced in for any kind of a result. Where are you still invested in India?
So again, we're quite diversified across the board. So China, 70% of its GDP is consumption. Now we're betting on manufacturing. So this is the next, I think, evolution of India, becoming the new China. So we believe that India is what China was 15 years ago. So it's for China's GDP to start transforming from 70% consumption, very similar to the US's, into manufacturing. And this is where things are transforming. So we are betting on manufacturing companies, manufacturing to start to move from China to India and from other parts in the world into India.
And I know you're in gold as well, center stage in your commodities portfolio, and also a lot of cash, 35% cash still.
Absolutely, and oil.
Waiting to see where all of that's going to get deployed. Ryan, thank you so much for joining us today. That is Ryan Lamond, CEO and co-founder at Neovision Wealth Management. Still ahead, it's Africa Amplified, our monthly deep dive into the continent's biggest stories. We'll be taking a look at the historic rise in cocoa prices and why the same factors are impacting other soft commodities. But first, the rise of UAE markets, with listings set to top $1 trillion in value. The details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Bonnie Quinn in Dubai. The UAE's once sleepy stock exchanges will soon be home to companies valued at $1 trillion, putting them on the cusp of reaching a distinction long coveted by the Emirates' rulers. The markets were already ranked number 17 in the world at the end of March, ahead of Brazil and Spain. Bloomberg's Farah El-Bahrawi is covering the story. So Farah, pretty incredible that we're at $1 trillion or close to it. How did this rise come to be?
Well, Vani, a big part of this was driven by companies on the Abu Dhabi Stock Exchange, and particularly those linked to Tahnoon bin Zayed Al Nahyan, who's one of Abu Dhabi's 2 deputy rulers, national security advisor, as well as the brother to the president. So a lot of his companies, and the biggest one is IHC. That one is a holding company valued at $240 billion, Vani. That's 25% of the 1 trillion market cap. This one has seen a 42% rally over the past 5 years. So it's been a massive market, part of the market. We've seen the market rise from $250 billion to $950 billion in the past span of 4 years. IPOs have been a big part of it, but it's definitely Sheikh Tahnoon's empire that's helped Abu Dhabi's market rise threefold.
Is it retail investors getting in here? Is that what's sort of bloating things?
Well, it's not just retail investors. There is a massive UAE local investor base in the country, but we do have some foreigners definitely in the market, but I think that the concern here is that there's still not enough available for foreigners.
Talk to us about how Sheikh Tahnoon's influence in the region changes slightly, how everything gets positioned in the stock market.
Absolutely. So Sheikh Tahnoon's companies, or those that he oversees, make up at least 65% of the benchmark. And he also oversees the ADQ Wealth Fund, which owns the Abu Dhabi Securities Exchange. So that's as if a person oversaw the New York Stock Exchange, as well as 2/3 of the companies on the S&P 500. So that's how the UAE is kind of different from other markets. And there are still concerns that foreigners aren't really able to access these companies because there's still some preferential allocations to the local investor base.
And they're waiting for that to change. I know there's a lot of foreign interest. Farah, thank you so much. Wonderful story. Do check it out, everybody. That's Bloomberg's Farah El Bahrawi there joining us here in studio. Plenty more ahead. Stay with us. This is Bloomberg Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Bonnie Quinn in Dubai. Saudi Arabia's quest for $100 billion in foreign investment by 2030 is faltering. The kingdom is carrying a bigger spending burden for mega projects as it tries to become a global hub for future industries. Joining us now is Bloomberg's Zainab Fatah. So what is the current picture, Zainab, and what is the plan? Why is Saudi struggling to boost investments?
So Saudi Arabia wanted or envisioned around $100 billion by 2030 in FDI. So far, it's been averaging about $17 billion. We were told that around $19 billion came in for last year. So far, they have not been able to attract that amount of investment from abroad because investors remain cautious on the country. They don't understand it very well. Some of the sectors there still need a lot of experience and development before you would get the heavy hitters to come in. And also there are also hesitation about the legal framework there for a lot of investors. Laws are not tested for many of them. For a city that's being built from scratch like Neom and is expected to have a different legal framework than the rest of the kingdom, that's even more tricky. And that's why we are seeing a lot of investors sit on the sidelines and not bring in a lot of capital.
Saudi is in great shape economically, though. I mean, last year was in contraction, but in general, it's in okay shape, right? And they are bolstering their capital markets and their regulations, and the regulators are getting involved, and they are trying to attract more, and they're making efforts. So why are investors a little bit, hesitant? Is it partially to do with the types of projects that they want to get funded?
Well, there are different ways. So a lot of the projects we have around construction and building up new cities, they call them the giga projects. And you have also investments that the kingdom wants into heavy industries, into mining, into manufacturing, chip manufacturing, car manufacturing, EVs, and so on. In all of those areas, still Saudi Arabia lacks the fundamental infrastructure around it, the supporting industries around it, the supply chain, to build up those industries and make Saudi Arabia attractive to those investors to come in and set in. And that's forcing the kingdom to carry much of that burden itself for now, at least to start it off and then bring investors in.
So preliminary data for 2023 showed FPI below target, about $19 billion. The implications, would be pretty, not great for the kingdom. So what will the kingdom do to try and overcome any deficit?
So right now it's doing several things. First, taking on most of those projects themselves. They're finding that they're going to have to underwrite trillions of dollars in these projects. They are being forced to reprioritize, to cut back, scale back, and also go to the international markets, raise funding through issuing bonds and getting loans to fund those projects. But overall, they're relying on oil, and which basically their oil price break even is becoming higher, not lower.
Exactly.
In many ways for this period. They're going step by step, and they're trying to update their laws and regulations and bring in investors. But really, they have to kind of think again at the scale of the projects that they were trying to bring in.
Briefly, Zainab, the investments that are coming in, where are they coming from?
So far, we know of Amazon bringing in, pledging with the partners around $10 billion to build data centers in the country. There are some investments are expected around, building up their housing infrastructure and a lot of the real estate that needs to be built, entertainment cities and tourism and so on.
All right, Zainab, thank you so much. It's a fascinating story and will continue to be one. That is Bloomberg's Zainab Fattah. Well, speaking of FDI, Argentinian President Javier Milei is striking a more pragmatic tone when it comes to China. This comes just a few months after threatening to curb ties and calling the Asian giant a, quote, assassin. In an exclusive interview with Bloomberg, Milei says it's business as usual.
As for the Chinese government, what we've always said is that we are libertarians. And if people want to do business with China, they can carry on business as usual. What I said was that I wouldn't be aligning with communists.
Javier Milei there, and you can check out the rest of the interview today on Bloomberg Television. Let's check out how the Middle East market fared yesterday, though, after we saw an absolute dive for U.S. stocks in the afternoon. Well, before that happened, we did see some gains for the Middle East, particularly in Qatar, who's had a basically very difficult few days. In fact, a difficult week. That's the first up day for Qatar this week, up 1.3%. The DFM General up a couple of tenths. The ADX in Abu Dhabi up 1/3%. And the Tadawul was led by the banks, up 2/3%. Coming up, it's Africa Amplified, our monthly deep dive into the continent's biggest stories. This week, the historic rise in cocoa prices. This is Bloomberg.